Let me ask you a question. When it comes to investing, what do you think is more important? What you actually buy or all the things you don't buy? See, most people are always focused on what to say yes to, but the real secret, the key to long-term success, it's all about having the discipline to say no. And look, you don't have to take my word for it. Warren Buffett absolutely nailed it with this quote. I mean, just think about that for a second. Really successful people say no to almost everything. This isn't about finding hundreds of pretty good ideas. It's about finding a tiny handful of truly exceptional ones and then protecting your money from everything else. So in the approach I use, which is pretty much modeled after how professional family offices manage money for the ultra-wealthy, this number is everything. 99% of the time, the answer is just plain no. We'll look at a stock, we'll analyze an idea, we'll see a new trend, and we pass. We are always on the defensive, actively looking for reasons to say no to an investment. I call this the sniper mindset. You know, you're not just out there firing wildly, hoping you hit something. No, you're waiting, patiently, for that one perfect shot. So the big question is, how do you know when to pull the trigger? Well, you need a system, a repeatable, unemotional, and systematic checklist. And this is the result of that disciplined system. My portfolio has grown to over 88,000 pounds, and that didn't happen because I was trading every day. It happened because I only pull the trigger when a company passes a really rigorous set of tests. And today, I'm going to give you that exact checklist. All right, let's dive right into the checklist. Rule number 1 is without a doubt the most critical of them all. Before you even think about the stock price, before you look at a single chart, you have to ask yourself this one simple question. Does this business have a real, durable moat? Now, a moat is pretty easy to understand, but it's incredibly powerful. And I want you to focus on that word unfair. This isn't about being a little bit better or having a slicker marketing campaign. It's a structural advantage. It's something that makes it nearly impossible for a competitor to come along and just copy what you do. Okay, let's make this real with an example right out of my portfolio. On the left, you've got SoFi Technologies. What's its moat? It's simple, a national bank charter. This means they can use their member deposits to fund their loans and they get to keep the entire profit spread. Competitors like PayPal and Block, they can't do that. It's a massive unfair advantage, so that's a pass. Now on the right, you've got BigBear.ai. The moat there? It's much weaker. They're a small fish in a giant pond with sharks like Palantir swimming around. So for me, that's a fail or, at the very least, a watch. And you can see exactly how that thinking plays out in the portfolio itself. SoFi has a super strong moat, so it earns a really significant 21% position. It's an anchor for me. Big Bear, on the other hand, has a weak moat, so it only gets a small 5% speculative spot. The rule here is dead simple. The strength of the moat dictates the size of your bet. Okay, let's move on to rule number 2. Now, this is a silent killer that I think most retail investors completely ignore. You might see your stock price ticking up day after day, but you could actually be losing your ownership stake in the company. I want you to think about it like this. A company is a pizza. Every time the company issues new shares, maybe to pay employees or fund a project, they're slicing that pizza into more and more pieces. That's called dilution. Now, if they're creating new slices faster than they're growing the size of the entire pizza, well, your slice is getting smaller. So the rule is simple. The revenue growth absolutely has to be higher than the dilution rate. Let's apply this to another one of my holdings, Nebius Group. It's a perfect case study. Their revenue is growing at this blistering pace, over 100%. That's fantastic, right? But they have a big equity program to fund all that expansion, and it's diluting shareholders by about 10% a year. So since 100% is way bigger than 10%, it gets a pass. But you can bet we are watching this one like a hawk every single week. All right, rule 3. This is where we talk about valuation. And this is where so many people get tripped up. They get lost in all these confusing metrics that don't really tell them what they need to know. What we need to do is figure out what kind of future the market has already bought and paid for. So, first things first, we're going to take the old-fashioned price-to-earnings ratio and just throw it right out the window. It's a backwards-looking metric. We need to look forward. And we do that with a tool called a reverse discounted cash flow model. Now, don't worry, it sounds complicated, but the idea is simple. A normal DCF tries to guess the future to find a price today. We just flip that on its head. We start with today's price and ask, okay, what growth rate does the market expect for this price to make any sense? We're basically reverse engineering the hype. And here's how this simple question leads to crystal clear decisions. When I ran this analysis on Palantir, the market was pricing in 40% growth every single year for the next decade. I mean, that's just an incredibly high bar to clear. For me, that was a clear fail, and I sold my position. But then look at AMD. The market was only pricing in about 15% growth, and given their central role in the AI boom, that felt way too low. That was a pass, so I bought more. So, we've covered the business with the moat test, we've covered the ownership with the dilution test, and we've covered the valuation with the reverse DCF. But a company isn't just a spreadsheet of numbers. It's run by people. And just as importantly, you're a person too. So the final two rules are all about the human element. Rule 4 is the insider signal. This one is so simple, but it's incredibly powerful. You just ask, what are the people in charge doing with their own cash? At SoFi, the CEO, Anthony Noto, is constantly on the open market buying shares with his own money. He's putting his skin in the game. But at Palantir, the CEO, Alex Karp, has a preset plan where he sells stock almost automatically. The signal couldn't be clearer. You follow the leaders who are eating their own cooking. So we've covered the company, the valuation, and the insiders. That's 4 really powerful checks. But none of them, and I mean none of them, matter if you fail this 5th and final test. What's the one rule that if you break it, makes all the others worthless? It's this one right here, the life moat. And notice, this has absolutely nothing to do with the stock market, and it has everything to do with you and your own life. It's your personal defense system against all the curveballs life is going to throw at you. Because if you don't have one, you will be forced to sell your best investments at the absolute worst possible time. So what does a life moat actually look like? Well, it looks like this. A cash buffer. Yeah, I'm talking at least 10,000 pounds sitting in a boring, easy-to-access savings account. This is not investment money. This is life happens money. This is the money you use when your car breaks down so you don't have to panic sell your best stocks in a down market. You earn the right to be a long-term investor by being prepared for the short term. And there it is, your complete 5-point checklist. It's your new toolkit. You check for a real moat, you check the dilution, you check what growth is priced in with the reverse DCF, you check the insider signal, and most importantly, you check yourself to make sure you have a life moat. So here's the bottom line, the hard and fast rule. I want you to print this checklist out. Be ruthless with it. If a stock you're looking at doesn't get a clear pass on at least 4 of these 5 rules, it's not the perfect shot. The answer is no. You just walk away and wait patiently for the next opportunity. Because at the end of the day, that discipline, that's your shield. That's how you protect your money from bad ideas. It's how you let your great ideas run. And it's how, over the long haul, you defend the magic of compounding. Use the checklist. Defend the compounding.